Okay, welcome. Good evening, good day, good morning, whatever time you'll be watching this much later. This is a mentorship course, and what I intend to do, as I've said, we'll talk about introduction to smart money. Introduction to smart money. So, what do I mean by smart money or smart money concept? Smart money are simply the bounds. They are simply the bounds. So smart money, by smart money, I'm simply talking about the banks, all right? The banks. The banks, because for every candle you see that prints, there is somebody printing it, okay? So whether it's bearish or bullish, there are activities that is going on in the chart that makes for that candle to be printed. So by smart money, we're talking about the banks. And these banks, they're the one that does the trading. We just try to leverage on their position. Okay. So by smart money, we just simply mean the banks that are trading. Now, if you go through some of the videos we have, you'll discover that we make mention of smart money every now and then. Then you begin to wonder, what is smart money? These are simply the banks that trade large volumes, like large positions. They buy and they sell assets, they sell commodities, they sell features. So primarily what they do, they want to hedge their funds, buy at a particular level, and then also sell at a particular level. So that's why we call them that they are smart money. So when we refer to smart money in any place, we're just majorly talking of what they do, how they do it. So their concepts, over time, a lot of traders have been able to find out, okay, this is what it means, or this is how they make their moves. So I just want to explain the just brief concept to you tonight, or how smart money makes their move, just how they make their move. All right, that's what I want to explain tonight. So let me just give you a little background. Okay, I wanted to check out Chrome. Let's see. Let's see if we have a definition here. Smart money. Okay, let me check this first. All right. Look at what we have. Smart money concept is the combination of key levels, strategy, and traditional supply demand zone with market structure to optimize win rate, reward per risk ratio, and help trader to control emotion. All right, it's cool. It's fine. different definition. Let's look at this next one. Let's look at this next one. What is smart money? Let me click on this and see. Okay. All right, let's look at this definition. It says the simplest way to describe smart money concept trading is to say that it is price action by a different thing. Yeah, all right. Okay, maybe smart money is not just a forex trading strategy, but an entire philosophy about how the market works. Basically, smart money states that market makers, which are the banks, hedge funds, and manipulative entities. Let's debug this story. This is what I just want you to know. These are market makers. They are the one behind the candles you see print at every level. It's not your 1 lot size, 2 lot size, 0.5 lot size that print this candle, right? It's the smart money that prints all these candles. So you just want to follow what they are doing. That's the smart money concept. So if smart money is buying, you want to also be buying. Smart money is selling, you also want to be selling. Because these are the two things that happen in the market. It's either a buy or a sell. Any candle you see here, it's either buying or selling. So that idea that price is, we teach all these things at elementary level. We say consolidation market, price moving at a zone. Whether it's moving at a zone or moving at support and resistance, it's still two things. Price is either buying or selling. You get now? So you have a resistance up here, you have support up here. So whether price moves within this zone, it is still two things. Either price is buying, bullish, or price is bearish. You get it now? So if you have this concept in your mind, you now want to try to be on the side of smart money, on the side of the bank, which is referred to as the big boys. You want to be on their side. You get it now? So it is being on their side that we now refer to as smart money concept. People try to find out how they trade over time, and then they try to make recommendations. All right, this is what we have observed, that anytime the banks wants to buy, they'll first of all sell like this. If they want to buy, they'll first of all sell, then they will buy. This is what smart money does. So if they want to buy, they will first of all sell. So sometimes you hear a buy to sell candle or a sell to buy candle. Anytime they want to sell, they first of all buy. If they want to sell now, price around it, they first of all buy, then they will sell. This is what they do. So people now create a concept around it that when smart money wants to move, they leave some signature, which is now called price action, which we refer to as price action. So you want to trade price action, not line, indicators and all of that. We all started with indicators and they messed up our psychology. But you want to just trade the naked chart and know what price is doing. So tonight I've shown you what different ideas of smart money and all of that. You can just read up smart money concept, other blocks, breaker, fair value gap, and all of that. They are all smart money concepts. Yes, they are all smart money concepts. Like you can see here, SMC sounds highly technical when you first start reading about it. You find yourself scratching your head at the basic vocabulary. And to help you out, here are some common terms: order blocks, breaker blocks, and mitigation blocks, fair value gap or IPA. So these are all the concepts that are called smart money concept or SMC. Is that okay? So let's go to the concept. Is the concept I want to introduce you to, not the bank. I just want to introduce you to what they do, how they do it, so that we can always fall at the right side of the market. because you don't want to go against smart money, you don't want to go against the bank. Banks are opening $1 million worth of position, and you're opening $10 position, and you want to push them out of the market. It's laughable. It's not possible. So let's look at their concept now. Like I said, smart money does two things, or market or price does two things. Price is either bullish or bearish. Price is either bullish or bearish. These are the two things that price will continue to do in the chart. Bullish or bearish. So for bullish momentum, you want to see price giving you this formation. This formation. That's bullish momentum. You must be able to clearly identify this bullish move. That's what price action is, bullish price action. So like I said, if smart money wants to now sell, assuming this is a bullish market, as you can see, price want to sell. The first thing price will do is smart money will accumulate liquidity. After accumulating liquidity, they will take the liquidity out by themselves, and then they will go opposite direction. So they can do something like this. They come and create things like this. Then they can clear this, and then they can go down. So you now be wondering what happened here. High, low, high, low, high, low, a high, a low. Price went up and price break below this. So you are going to be tempted to call this a break in market structure, expecting to now short. But this is just liquidity sweep, because price didn't mitigate 50% of this level. I've taught all this in the course. So you want to ensure price get to 50% of this level, which obviously you see that price didn't come to it. So long price didn't come to 50% of this level, there is every possibility it's just a move. This was the real move. So this is last high. Price went here, created this, and price now moved, swept this place, which we call liquidity sweep, and that same move led to a break of this low. Anytime you see something like this, know that smart money was fully involved in what happened here. Anytime you see price like this, just know that smart money was involved. Liquidity sweep is there, break of structure. So they actually want to sell. That was why they pushed up to this high and rallied down. So anytime you see this, this is what we now call our model formation. Price gives you this model formation. Then you want to wait for price to come to at least 50% of this whole move, this move that sold, that bought and sold. This buy to sell move, where the buy started from, that took previous sellers and then resulted to break of structure. Because within that place, that's where you have your either order block, mitigation candle, fair value gap, or whatever other smart money concepts which are being used. You get now, so from here, just want to make it very simple. Look for 50% of all of this move, week to week, and allow price to come back for a retest. Now, smart money is not actually a retest for smart money. Let me explain what it is. It simply indicates that these candles that are here, larger volumes were pumped into these candles to take out the people here and take out the people here, because these are liquidity points. Previous sellers were here, previous buyers were here. So smart money entered from here with let's say $1 billion. They pushed out all the positions that were here. So as they enter $1 billion here, then when price came to this same candle, they now entered $5 billion. So the $5 billion will push price down, which means their $1 billion here that was in profit is already at a loss. From here, it was in profit. As they injected 5 billion here, it's already at a loss. Because smart money is not looking to take partials and close. No, this move, they're already at a loss. So they will need to someday, I don't know when, they will need to come back to mitigate at least 50% and close 50% of their positions here. So when they come to close 50% of their position here, that's when you want to look for entry. You now want to look for entry around this zone, giving the same formation, and then you can now sell them because I've given you a signature price action that structure has shifted. That's why I call it a break in market structure. The structure has shifted from a bullish momentum to shorts. You now want to start looking for short position, bearish positions. You get, so this is just introduction to smart money concept. So you do not want to sell when smart money is buying. They are buying from here, then you see price come here, you now load position here, you want to sell. Hoping that because you open 10 lots, you are going to push this price to close below here. The answer is no. So we know that in this move, we are bullish, and that means smart money is in this market and they are buying. So you want to start looking for only buy opportunities at every low. As price come back to the low, price went up, break this structural point, price can you want to buy here. Price went up. As it break this place, you want to look for a buy opportunity at all the lows, like all the lows. That's what you want to look for buy opportunities. Since we are bullish, so we follow price. We just follow price. We are not trying to think of what price we do. We only react to what we see price do. So long this market is still bullish, look for only bullish entries, only buy opportunities, like only buy opportunities. So long price is still bullish, only buy opportunities. Until price now gives you this buy to sell move. A first liquidity sweep is there, which must be clearly seen, and then a break of structure which must also be clearly seen. Then when this happens, we now want to wait for price to come back to 50% of this move, because most of the times smart money will leave footprint either within this 50%. There will be an order block, the actual candle that cleared this liquidity. That's the order block, the actual candle. You will see it. Sometimes there will be a fair value gap. Why do you have a fair value gap? The candle moved so much that price couldn't come back to close it. Because for a balanced market, every candle must have a wick, like you can see. Every candle must have a wick to the upside, to the downside. So as price moved up, let's say assuming this candle price moved up with that fast move. This was the last week here. This is the next week. Look at this week. This was the week. This was the week. So here there was no week. What did you see when this next candle opened? When this candle opened, the first thing the candle did was to trade into this place that there was no week. Because this week stopped here. This candle needed to trade into this place before buying up. After buying up, because there was this imbalance here, price came back again to fill that place. So there's no vacuum in the market. Price must come back to fill it. Price came back, filled it, and price now rallied away. Now check this candle. When this candle moved up, the wick stopped here. See, that's the wick. The wick stopped here. So when this candle open, candle have to open here, it pushed down a bit. push down a little to come, and though the imbalance was not filled, but at least they traded into this whole empty candle without wick. Every candle must have a wick to the left, to the right, and price ran away. Now there was a lot of volume in this candle. Look at this wick. So this wick stopped here for this candle. This wick stopped here. This wick stopped here. This is what we call imbalance. It's also a smart money play. It simply means there was a lot of volume here. So price came back down and filled it. That was why this candle came back, filled it. So in an attempt to make another high, price couldn't make a high. Price now started coming lower since then. Price started coming lower since then. But if you check up, there was no imbalance. The only imbalance that was there when price came down, price went back to fill it. Look at it. When price came down, price didn't just continue going down. Price has left an imbalance here. Look at it, there's already an imbalance in this candle to this candle. There's a tiny imbalance there. Tiny. That was why this candle went up to fill it. And couldn't make another higher, price kept going down. So this is how candles are printed. So what smart money does is that they add volume to that candle to take out the previous sellers. This is your buy side liquidity. They take out previous sellers and push down, breaking this last low that was created. So once you see this model formation, that is what we call smart money concept. This model formation. They have showed you a signature. They have showed you a model. Okay, this is what we want to do next. You can now read their price. You can read their move, because this is like a footprint. Okay, we have taken out, all right, we have taken out all the previous sellers here, and then we also came and took out the previous buyers here. Now their position here is in drawdown. They come back to mitigate it. So what is here can be a mitigation candle, or the other block, or they will trade into the fair value gap, and then they keep moving down. Also, if it's a bearish formation, like you can see, price will come first, capture this liquidity, and then we close above. So price will come, capture the last previous buyers, takes them away, and price rushes to the opposite direction, breaking this place. So this becomes your break in market structure. We have taught almost all these things in the videos in the class, in the library. So you see, price will do this again and again. So once you see this happens, that is when you want to start looking for, you have to wait for when price will come back to 50% of this move, which we have taught over and over again. Just measure the 50% here, and then wait for price to return back. Because most times, not that you just see this and you don't set limits, you have to wait for price to come in. Most times, price will come to the 50%. Most times. And then we can keep going up. What this thing means is that we're bearish, we're going down, but a lot of volumes were pumped here to capture these previous buyers, and a higher volume pumped into this place to capture previous sellers. So their position in this place is in drawdown. They come back to mitigate out of their position, and price runs away. So this is smart money concept. This is what we trade, and that's what we call the smart traders network. This is what we trade. We want to see that formation and then wait for entry. So sometimes this waiting can be hours. You know, this waiting can be days, it can be months. So your understanding of substructures, trading range, and our trading components will now help you to be able to take trades in within the time you are waiting for price to come back here. So there are ways to catch this retracement, there are ways to catch this, there are ways to, you just want to stick to what you have understood. So in the course of the, in the course of the upcoming boot camp, I'm going to speak on how to take lower time frame entries and all of that. But basically, this is smart money concept. And the other concept we've talked about are in the library. But this is what you want to wait for again and again. Let it play out, then you can now take entry. So if price is to come back now, price will come back here. As price start coming back, you're not just going to enter here at 50%. You want to wait for that same model formation. Price will give you something like this, and price will sweep this low and break above. Then you wait for it to come back, and then you can capture it. It's the same thing price will do. Price will come, give you that same formation. That's the model, that's the signature. Break this low, take out all of these previous buyers that are trying to push price here. They'll take them out, and they will close above the last structural point, give you a break in market structure. So once price break, this retracement can go as far as like this. But you want to wait for it, let it retrace. Because you have a knowledge that we are bullish. So you want to wait for price at this zone till price return. Yes, sir. Price will always capture liquidity and break structure. That is smart money concept. That's their signature. It's all the time. It all the time, price will capture liquidity. Yes, sir, it happens all the time. Price will capture liquidity and then break structure to the direction which already either established or a new direction. So this already established a high, a low, a high, a low. Price comes, you're expecting a low. Price gives you this formation here. You can get an entry here. So your stop loss is no longer going to be, okay, you enter here. Stop loss is not coming back to this low. Price has given you this low. So here becomes your stop loss. Then your entry is now here. And then you can now choose to take price up. You get it now. So this is how we trade. Allow this model formation to form. It's safer than just waiting for price here. Let's say 50% of this and put stop loss all the way to this level. If you take 50% of this, you see, you want to take 50% of this and allow price to get to just enter here. No, it's not safe. Right? The stop loss will not be within our risk appetite, which we have taught. So you want to wait for price here. It gives you that formation, and then you can, once price gives you that formation around this zone, then you can get an entry, then we take price higher. That is the model we teach and what we trade. Is that okay? So I'm going to save this right now, and then let me apportion someone that will send the next link.